In chapter one, we focus on how to prepare what's known as different types of financial statements. So you think about the different types of financial statements prepared by most corporations. We're talking about the income statement, retained earnings statement, the balance sheet, as well as the statement of cash flows. These are the primary types of statements required by both the IFRS, which are the international accounting standards, as well as US GAAP, which of course are the United States accounting standards. So if you are a public corporation, you are required to prepare these statements on an annual basis, and this information is made known to the public. So the question is, do you know how to prepare these four different types of financial statements? And once they've been prepared, are you able to interpret and analyze the information that's shown on these different types of financial statements? So, you ready to get started? Let's go. All right. First, we begin with a statement known as an income statement. Now, I want to first pay attention to the actual heading. The heading answers three important questions: the who, the what, and the when. Who's the who? The who identifies the name of the business organization. The what identifies the type of statement being prepared. And the when shows the time period that's being covered by the financial statement. So we have the Sierra Corporation preparing the income statement for the month ending October 31st of 2017. Now, it is important that you understand what types of accounts are going to appear on these different types of financial statements. So on the income statement, it will list your revenue accounts as well as your expense account. When you think about revenue, revenue shows an increase in assets that has been earned either from providing services to your clients, selling a product to your clients, or a combination of the two. We're going to itemize and list the different types of revenue that has been earned for the indicated time period. So what we have is service revenue earned for the month of October, total $10,600. So you'll first list your revenue accounts on what's known as the income statement. Next, we'll list all of our expenses. Perhaps you're saying, what is an expense? I'm glad you asked that question. Expenses are a decrease in assets or an increase in liabilities in order to earn revenue for the business organization. You heard the phrase, in order to make some money, you got to do what? You got to spend some money. That's what expenses are. So you think about yourself. When you work as an employee, you're actually at expense of that organization, because when they pay you every week or every 2 weeks, they recognize an account called salaries and wages expense. So on the income statement, we're going to itemize and list all the expenses that have taken place for the specified time period. We'll get a total of all of our expenses. When you think about why does a company go into business, it's to make money. So the income statement will show us whether we made a profit, which is called net income, or if a net loss took place over a specified time period. To determine whether you have a net income or a net loss, subtract total expenses from your total revenue. Again, subtract total expenses from your total revenue. If this number is positive, it means that we earn a profit for the period, which is known as net income. If this number is negative, then a loss has taken place, which is known as a net loss. If we have a net loss too frequently, then that's known as bankruptcy because it means you're losing money as a business rather than earning money. So the income statement lists your revenue accounts and your expenses to determine whether we've made a profit, which is called net income, or if a net loss has taken place over the time period indicated on the heading of the income statement. Okay? Next up is a statement called the retained earnings statement. The word retain means to keep. What are you keeping? You're keeping your earnings. So again, you're heading the who, the what, and the when. For the retained earnings statement, your first line item will be your retained earnings beginning balance. For our illustration, this is a brand new company, and this is their first month of operation. Therefore, their beginning balance will be zero as of October 1st. We're then going to add in the net income that was earned. This net income amount is coming from your income statement. So the net income or net loss shown on the income statement is transferred over to your retained earnings statement. Then we'll see if there are any dividends paid out. Dividends refer to payments made to the stockholders of the corporation. Dividends are an outflow of cash. So if we pay any dividends out, it is subtracted from the total of our beginning retained earnings, along with our net income. Subtract out any dividends paid out to get your ending retained earnings balance. So as of October 31st for this company, they have retained earnings in the amount of $2,360. So I think about the statement of retained earnings again. This statement focuses on what portion of the profit that we earn has been kept by the company and not paid out in dividends to the actual stockholders. So again, we earned for the period 2860. We paid out 500 in dividends. Therefore, we retained or kept in earnings a total of $2,360. Okay? Next up, we have a statement known as the balance sheet. The balance sheet is a snapshot of a company's financial position as of a certain date. So notice the heading, the who, the what, and the when, but notice the date for the balance sheet. It doesn't say for the month ended. It says October 31st, 2017. That's because the balance sheet is for a specified date. The balance sheet is not for a period of time. So the balance sheet first lists all of the assets and it shows each asset account balance as of October 31st of 2017. When you think about assets, assets are things of value that are owned or controlled by a business organization. On the balance sheet, we're going to itemize and list all of our different asset accounts and get a total of the assets. They total $21,910. The next section is called our liabilities and stockholders' equity section. When you think about your liabilities, these are the existing debts or obligations of a business organization. So when a company owes another company, they have what's known as liabilities. Most of the time, your liability account will end in the word payables, meaning that we have to pay someone at some point in time in the future for either borrowing money or for receiving products or services that we have not yet paid for. There's also an account called unearned service revenue that we'll discuss more in detail in another chapter. But whenever you see the word unearned service revenue, that is also a liability account. It means we receive cash before we provide an actual service to a client, which makes it a liability. So you're going to itemize, list all the liability accounts, and get a total for your liability accounts. They total $9,550. Our last section is a section known as stockholders' equity. So when a corporation sells shares of their stock, they're sold to what's called the stockholders. So this common stock section represents the amount of shares of stock, the value of those shares of stock that have been sold to the actual stockholders. That goes in this section. And then we have the retained earnings. Now, the retained earnings balance is coming from your statement of retained earnings. It is not the beginning balance, but it is the ending balance because we're now at the end of the accounting period. So the 2003 zone here is transferred from the retained earnings statement over to the equity section of the balance sheet. So I'm going to add up my common stock and my retained earnings to get a total equity of $12,360. Now the balance sheet must do what? It must balance. Your assets must equal your liabilities plus your stockholders' equity. So when I add my liabilities to my stockholders' equity, when you add those two together, they must always equal the total of your assets. If those amounts do not balance, you must figure out what is causing your balance sheet to be out of balance and correct the error. As an accountant, we are problem solvers. We cannot leave the balance sheet out of balance. We must figure out again whether we transpose a number. Is there a mathematical error? Do I have the right figures in each category? Again, you have to figure out what is causing your balance sheet to be out of balance. To keep this video short, I'm going to stop here for this first section. Then I'm going to do a second video that will focus on what's called the statement of cash flow.